In the financial market, each day is a battle, and the greatest battle we can overcome is ourselves. So let's talk about self-destructive behavior in the financial market, which refers to actions driven by emotions, psychology, biases, and a lack of discipline that consistently lead to poor financial outcomes. These behaviors are often subconscious and can be more detrimental to a portfolio's performance than external market forces. They contradict rational decision-making and can prevent you from reaching your financial goals. Common examples include: 1. Impulsive trading, making sudden unplanned trades based on fear, greed, or market hypes. This often leads to buying at the peak and selling at the bottom. 2. Herding or following the crowd, making investment decisions based on what everyone else is doing rather than on your own analysis. This can be fueled by the fear of missing out or the fear of being wrong. 3. Overconfidence, believing you have a special ability to predict the market movements, which leads to taking on excessive risks. Then 4. Loss aversion, the tendency to feel the pain of a loss more intensely than the pleasure of an equivalent gain, causing you to hold on to losing investment for too long, hoping they will recover, and selling winning ones too early to lock in a small profit. 5. Market timing, attempting to predict the perfect time to enter or exit a market trade, which is nearly impossible to do consistently. These behaviors are rooted in human psychology and are a core focus of a field of study called behavioral finance. To overcome this destructive behavior, it's essential to move from an emotional, reactive mindset to a disciplined, proactive one. Here is how to apply this to your own financial journey. 1. Define your plan and stick to it. We discussed creating a clear financial plan with specific long-term goals. Your plan is your anchor. Before making any investment decision, refer back to it. For instance, if your goal is long-term growth for retirement, a sudden speculative trade doesn't align with that objective. 2. Automate your good habits to combat impulsive decisions. Automate your savings and investment contributions. Set up regular automatic transfers from your investment account. This removes the need for a conscious decision each time, ensuring you consistently invest without being swayed by daily market noise. 3. Implement a cooling off period. When you feel the urge to make a sudden trade, especially one based on a news headline or a tip from a friend, introduce a mandatory waiting period. A 24-hour rule can be highly effective. This allows your emotions to subside and give you time to assess the decision rationally based on your established plan and research. 4. Embrace a long-term perspective. The daily fluctuations of the market are just noise. Focus on the bigger picture. Instead of checking your portfolio multiple times a day, limit yourself to a weekly or monthly review. Remind yourself that you are investing in companies' long-term growth, not their minute-by-minute stock price. 5. Focus on process and not outcomes. A single profitable trade doesn't mean you are a market genius, and a single loss doesn't mean you are a bad investor. The key is to focus on a sound decision-making process. Did you follow your plan? Did you do your research? If the process is solid, the outcomes will follow over time. This approach reduces the emotional weight of individual gains and loss. 6. Seek knowledge over prediction. Instead of trying to predict the market, Focus on understanding the fundamentals of your investments. Read about the companies you own and the economic trends that affect them. This knowledge builds confidence and reduces the need to rely on God's feeling or the opinion of others. By implementing these strategies, you can build a more resilient and disciplined approach to your finances, safeguarding your portfolio from psychological pitfalls that affect even the most experienced market participants.